Hello, traders. It is Thursday, I believe, May 11th. Hard to believe we're almost halfway through with this. Let me turn my fan off. I always forget. Some of you guys are on headphones, and I will apologize ahead of time. They tend to fly the fighter jets right around now. So if you're wearing headphones, you might listen for a rumble, and if it starts to rumble, just hit that volume like mute button if you have to, because or just listen to this on like your phone or something, because those jets hurt my ears whenever I have headphones on, and that's what you get for living in Vegas next to a airbase. So this is Red Ben Trader. You can find me on Twitter at Red Ben Trader. We're going to be looking at the screen that I have for live trading and analysis is looking at the algo that I use that's based on the Trade and Perform algo. That algo is built by my coach, Simon. If you want to get a hold of Simon and talk to him about getting a similar setup on your computer and to join the futures trading room we're in, where we trade futures every day, there is a cost associated with that. But I'm not gonna go into that. I'm not gonna answer questions about that because it's really not. I'm just a member in the room. So if you want to learn more about the room or the algo or any of that stuff, contact Simon, and his email is trade the letter N wordperform@gmail.com. Okay, so for those of you who have not seen any of my streams, this my screen is going to be really foreign and confusing. So I apologize ahead of time for that. But what for those who have watched a couple of them, what you'll probably be able to agree with me on is once you learn what you're looking for, the novelty of the algo, it actually, you realize that there's a learning curve. That's what I'm trying to say. There is a learning curve. At first, there's lingo and there's signals that you need to learn and patterns that you need to learn, and so it's a little bit overwhelming. It's a little bit like learning a new language at first, but once you get it, and you just get the mechanics of how it works, and you realize that you don't actually need to know what any of the signals mean to trade it. And for some people, the more you know, the harder it is to take the trade because you start overthinking it. Others of us feel the need to know what all the signals mean to be able to trust the signal. So and you might be anywhere on that spectrum. You may be someone who really should be spending their time just learning to execute, learning to pattern recognition and execution, and just hammer away. The very best traders I know, the very best futures traders anyway, that I know, that's how they approach this game. Is they don't even think about what everything. They don't even do any of any analysis on the fly when they're making decisions. They do analysis ahead of time, but once they know what they're looking for, they just go in and look for that pattern and just execute the plan over and over and over and over again. And they are the most, those in the room who do that consistently are the best traders on our team. So I have to admit that, right? And I am definitely not one of those traders, right? They say they know what they're doing, or at least are learning, and some of them are learning a lot faster than I have, which is cool. But those who are doing really well have gotten over the initial feeling of I'm overwhelmed with all of these signals and I don't know what it all means, and rather than letting that part of it bug you, they just kind of submitted to the fact that I'm not going to be able to analyze in real time anyway at the speed that I'm trading, and all that really matters is that I know what I'm looking for and where I'm looking for it. And beyond that, the hard part about this is being able to push the button at the right time and being confident with it so that you can stay in the trade until your target and do everything right. Because it's one thing to know like when to push the button. It's a whole nother thing to actually do that. And that like execution side of things is really where I struggle personally. But a big part of that is because the way my brain works, I feel the need to analyze everything. And I'm good at it, which thankfully, but it doesn't always help my trading because while I might be able to, you know, identify patterns and tell you what each one of these little things are kind of telling me, having all of that extra information in my head sometimes gets in the way of the fact that all I really need to do is know when and where to push the button and which button to push. And if you overanalyze everything, you're going to second guess every one of those decisions because there's always going to be evidence that your trade will work, and then there'll always be evidence against the trade working because the truth is we don't know which trades will work and which ones will stop, and that's just a fact of trading. So if you get over the fact that you don't know what every little signal means and you get over the expectation that you're going to avoid every single stop, you can start to open up your learning and really focus in on what's important. And in my opinion, the two most important things for me when it comes to learning this is, first of all, what's my most reliable pattern? Something that every time I see it, I should be trading it because it literally works that often. Does it stop? Yes, every setup has stops. But I want to know which one of them, regardless of what's going on, if I can have a set of rules and I could like teach a computer to just push the button whenever these set of rules are present, if that computer would make money, I should be acting like that computer in most cases. Just logically, if there's a trade where it's like, hey, this sets up so often, or this much, when it sets up, it pays out so often, and when it loses, it doesn't cost me enough to overcome the profits that would be made if I just take every single signal. You need to know, in my opinion, I need to know what patterns those are so that I'm ready to just pounce every single time I see them. And you don't want that super reliable setup to be ultra, like, you don't want it to have too many components because otherwise you won't recognize it. Now, the nice thing about the algo is that rather than having to look at the DOM and look at this and interpret like what's happening, I do have the algo telling me with visual signals what it's seeing. And so if I needed to, I could break this down and I could say I can spin a story of what's going on here. You know, you have an aggressive trader. That aggressive trader had lots of pressure compared to what happened before, causing some compression and expansion, which is what the plus sign says. And then we had a pink bar, which was some sellers giving up. Then buyers came in at the top. They then gave up the low. We got continuation and then compression, expansion, right? The plus sign to the opposite direction. It's just the same thing in reverse. And they sold it a little bit more. They sold it right into where volume centered. That yellow line is where most of the volume is within the range of that bar. And so that star says there was an aggressive trader in there. And look where they came back to, right to where most of the volume was in that bar. And they found a buyer, probably the same buyer as the one that was here. But then as sellers began to give up, probably expecting this high to get taken, you can see that there was no follow through. Here we had follow through. Here, you know, all the sellers gave up and then there was nobody left to support that push. So we got a volume shift down, which is the orange bar. And now we are auctioning inside of this. And because it's Renko, we're not going to know whether or not this plus and this triangle are going to be valid until it closes at 13.4, 34.75. If it instead gets to 13.4, 46.25 first, before it crosses 13 for 34.75, these signals will disappear and we'll get a new set of signals for an up bar. And we'll get a glimpse of what that is as the bar crosses the zero line. But right now, what this live bar is telling us is that if we close bearish, the conditions that are required for a triangle down and a plus down, both of those conditions have been currently met, but we don't know whether or not those conditions will continue to be met until it closes, because it could suddenly close bullish, or if the signals have anything to do with like relating to where the close is compared to the previous one, or how much of something happened at the close versus the open. None of those things are really valid until the bar closes. Once the bar closes, oh hi Ronan, once the bar closes, come here. We'll know. We can be confident that those signals will continue. They can be trusted. But when it's live, this is just a warning that the conditions for these signals will be met at the close on one of these sides. Now, I know one of the conditions for the triangle down, as well as a condition for the plus down, I know one of those conditions is to close bearish. So if it closes bullish, I already know immediately that those are going to disappear, but that's the only time when they will disappear, is during the live bar and then immediately when it closes. Once it's closed, any signal that's there will stay there, with a few exceptions, and those are the exceptions are things I've added that are filtering devices that basically look at different charts. So like, for instance, there's one of the, or at least one of the signals is looking at this numbers bar chart, and which is a different time frame and a different type of chart. And when certain conditions exist on this chart, it's overlaying colors on this chart for me. So those will not disappear once the bar that it's identified with closes, but that is going to be a different time and a different price than when this bar closes. So for instance, these background colors here is based on delta divergence on a separate chart. So those are technically susceptible to like flashing on and then turning back off again until that other chart has a closed bar. So on another screen, I have that so I can see that it's closed. And so like this one, for instance, this back, oops, I forgot that's the different one. But the current background here will not go away now because this bar has already closed. See that? And this one back here can't disappear. But if there was a warning that there could be another background colored here, it could disappear by the time this closed, in the same sense as the triangle will disappear if we close this bullish. So it's super important to understand that, because when it comes to the indicators underneath and the volume and all, this is it's Weiss waves, so it's like accumulated volume, but all of these like lower indicators down here have the same rules as, oh, there's the jet, by the way, watch your headphones, it could come right over my house. Yeah, they have the same rules. So once this bar closes here or here, wherever this yellow line, which is the Williams percent R, wherever that is at that time will be where it stays. But you can, like, for instance, this little dip is not going away because that bar is already closed. But we don't know yet whether or not this yellow, see how it's moving, right? We don't know where it's going to land until the bar closes. And what that yellow line is telling me is, like I said, it's a Williams percent R, but on a Renko bar, it's a little bit, it's interpreted slightly differently, a little bit more purely than on a candlestick, because what a percent R is looking at is compared, where is the high on this bar compared to the distance between the high and the low. And if you think about it, every Renko bar closes at either the low for a down bar or a high for an up bar. So the distance between the close and the low is 0 here, and the distance between the close and the high is 0 here and here and here, right? All the up bars have the wicks on the bottom, and the down bars have the wicks on the top, because that's just the way Renko works. Sometimes you have a very small wick, in which case, if you look, let me just find a really obvious example here. So that one was underneath 0 or negative 100. If we get a very small bar, I guess this is probably the best right there. That tiny bar is something I call a mini bar. They are usually pink. But what you'll see, if we get another one here too, is if we looked at where the percent R was right before that, on this green bar here, so that's here, compared to where the percent R is on this bar, what you'll see is a very nice 45-degree angle, right? Because it's a nice tiny bar. Whereas if you have a very large bar like this, compared to the previous one, you're going to get more significant, nearing an exponential response by the percent R. The challenging thing for me is to remember that the percent R, kind of like stochastics, it's limited. Its range cannot go beyond 0, and it cannot go below negative 100. It just tops out. And on Stirachart, what that looks like is little like, see the missing piece right there? It's hard to see there, but if I go here, this, see how it's just like gone? It's just not there. It's because it's bottomed out. So the condition is negative 100, and it can't go any further than that. But technically, the market could continue to go further. It does not mean the market has to stop, but the math just like stops producing the well, how can I explain that? It's like it stops responding to it, right? And then it'll start responding to it once it is no longer 0 and it's anything under 0. It'll suddenly reappear. So that's just, it's something to remember, that like you can use the angle of this yellow line to tell you basically what the trend is and how strong the momentum is. Because if you think about what a small bar is compared to what a big bar is in Renko, a big bar basically is a bar with a big wick. So price, before it touched this, remember, see the Renko predictor? There's 13,450, and then the red one, whatever, and it's like a little dotted line right there. That distance is this number, 15 tick, times 2, basically, more or less. I believe it depends on if it opens exactly at the previous one's close or if there's a slight gap, but it's usually going to be 30 ticks, give or take, I believe. Because to print a bar to the downside after this close, you need to go 15 more ticks. And to close to the upside now, you have to retrace this entire bar's body and then go 15 ticks. So in essence, on a reversal bar, you need 30 ticks of movement for that bar to reverse. So here, to get a down bar from here to here, you needed 30 ticks of movement to the upside. But the important thing to remember is, if you look at this wick, what you actually see is the market actually came down here first, tried to push 15 ticks to the downside in the direction of the previous bar, and it couldn't do it. And then it went almost 15 ticks up, and then 30 ticks from there, right? It's 30 ticks from the close of the orange bar is where this bar closes bullish. So the longer this wick is, the closer the sellers came to getting an additional 15 ticks after a Renko bar closed, right? So what that's telling us conceptually is there are more sellers in these bars with the long wicks, and there's more sell pressure during that period. Whenever, remember, this has nothing to do with time. It's just however long it takes to move the market, either to target the lower target or the higher target, 13.4, 38.50 or 13.450. However long that takes is how long this bar lasts. It has no time component whatsoever. It's just the range, and did it hit it or did it not hit it? But like I said, it'll only close at those two levels, one or the other. So the result means that the big wicks, the ones with the big wicks, it's a little bit of a tangent, but I find it helpful to sort of understand. Like I said, that's just the way my brain works. But the bigger the wick, the more sell pressure and the more sellers likely were in that bar, yet they closed 30 ticks higher than the previous close. So in essence, that bar with the really big wick right here, okay, that bar there was a fight there for that price. Someone was interested on both sides, at least one person. It's kind of easier to think about this as like a seller versus a buyer. It's obviously like, thousands and thousands or even like hundreds of thousands of traders, obviously, if not millions of traders. It's a lot of volume, most likely. But if you think about it, just one or the other, like buyer or seller fighting against each other, they were both interested in this price range, but buyers ended up being the ones who were able to push the market, again, 30 ticks higher before sellers could even push it 15 ticks lower. So sellers tried but lost, and the result is an extension, right? Now, that extension here is really only 30 ticks, right? And there's 4 points in every tick, so is that possible? That's only... That should be, let's see. So this, though, it depends on what the low is. That's right. It depends on what the low is. So here, there was very little wick. So 40, let's say 46. And then here, it came up a little bit further than this close and had a little bit of a wick. So depending on how big this wick and this wick is, will change what this like wave size is. Because it doesn't necessarily stop right when the bar closes. So in this case, it went up to 54.50, and I said the low of this one was, let's say, 46. So it wasn't quite 10 points, right? 46 to 50. No, I already forgot. What did I say? Yeah, 54. So it is like 8 is right. So it should be at least 8, and then depending on the wick, it could be more than 8, and where you got in, whether or not you got in on a wick or not. But if you, on the 15 tick, if you're getting those 2 bars in a row and you literally bought the bottom, the open here, once you've gotten these 2, you've gotten at least 8 points, right? Depending, and then like I said, depends on how far this goes. But just to here, 54, and then from here, 46, right? So it'll be 10. It'll be 10 right here, but you then have a bigger wick, but not necessarily a third bar. Another important thing to remember with Renko is that everything's fractal. So if I look at this bar here, on the higher time frame, that bar on the 67 tick, where it takes 67 ticks of movement in the same direction to print a new Renko bar to either side. So from here to here is 67 ticks, and from here to here is 67 ticks. That one, you can see, is still open, right? It hasn't closed. So we don't know if it's going to close up at 13.472.25 or if it's going to close at 13.421.75. We also don't know if it's going to be pink or not because it's not closed. And then in addition, if you look at these on the bottom, we don't know whether or not that line is going to be touching the MA or if this line is going to be crossing the 0 line. We don't know until it closes. So you have to think about things with the information that you know already, which is usually the bar before. So, I guess this one already did close below it. So this is not going to change. If Oh, and then they just haven't printed it, which is kind of nice. So we don't even see it on this higher time frame until it prints. I actually didn't realize that. I might be able to change that, but that's kind of helpful, honestly, because then I'm not going to get confused. I didn't notice there was that little block there of black, and like I said, I can change that. But here, I'm getting this movement while it's live, and so I sometimes forget that that's not accurate necessarily until it closes. So but the point I was trying to make, it's hard to do it on a live bar, but let's take a look at a bar that has a big wick, but it closes bullish after a bullish bar. So here, after a bearish bar. So here we had a bearish bar, a little bit of a wick, and then a bullish bar, right? So we'll look right here, bearish bar, a bit of a wick, and a bullish bar, right? So on the higher time frame, that closed, that occurred and closed here. Whoops. That was this is the open. So the green is the open. That's the open of the bar. And the close is at 38.50. So let's put a line at 38.50. Okay, so the bar opens here. We don't know what it's going to be, right? It puts in a wick on the higher time frame. That's the wick from the open down. Then it closes bullish up here, right? So at this point, we now have this green bar closed, right? I mean, and so that wick here on the green bar, it didn't go very far, but if you look, that is this, right? This move down, and then the wick retraces, and then we get from, if we put the here, so there's the open of the bar, right? The open, the wick, retrace the wick, and then look what happens. This is your money. Okay? That is where the opportunity is, in my opinion. Once you know that you have a bullish market on a higher time frame, and you had sellers attempt but fail, right? Attempt but fail to turn it around here. That is your biggest opportunity point, in my opinion. Now remember, you don't know that it's bullish, that this is going to close bullish, the green one. You don't know that it's closed until 38.50, which is this bar here. Is it 38.50? Maybe I didn't. Here, I think I've got to snap this because I don't think it's right. Not that. Too many things. Snap. There we go. So that is when you know. And you can see that when this bar closed right here, you knew that green bar here was closed, right? So to be able to participate in what's really the biggest opportunity, that pullback here into the level, is you'd have to be acting before this green one closed, right? The big money trades, these are not the most reliable, but the biggest profit trades, the ones that give you the biggest profit besides the actual low, which I'll get there in a minute, but if you're saying that this one is too risky, right, too hard to get, and then the ones that are super reliable happen to the right here, okay, on a pullback here, if you got it, but the in between that is this pullback, in my opinion. That one is the attainable pullback. This one here. This entry here is the most attainable high odds entry. Whereas, like I said, if you instead feel the need to buy here or here and otherwise you won't pull the trigger, then what you need to do is figure out how to get in at that price when you have a better risk reward, like on near that price when you have a better risk reward. So either find a way to make this low your stop, rather than having to put your stop down here. If you can figure out a way to put your stop here and still have it work more often than it doesn't, then that reversal trade becomes really powerful. If you have to put your stop down here, getting long here before you've actually confirmed is before you've retraced. I mean, so remember, this is the wick, right? And remember, this is all fractal, so I'm kind of getting in. It maybe is a little bit confusing, but the idea is on a bigger time frame, this is just a wick, right? So once we've retraced that wick, can it go lower? Yes, it can, right? But we know that when it goes higher and closes bullish, there's a relatively strong possibility, since you've just trapped all of these sellers in the wick. If it was bullish on the higher time frame, there's a relatively good chance that it's going to lift. And you can see that a lot of times you don't get another opportunity back at that price until here. And at that point, it's too late, right? So there's two spots with opportunity. Try to make this as simple as possible. The 2 points with the most opportunity are here after the retrace of the wick on the higher time frame, but before the close of that bar, or here at the close of the bar price wise, but at a later time when they've either held it or reclaimed it with an aggressive trader like a star on the algo. Whoops. So again, the green bar in the higher time frame, it closes here. This is when you could buy the breakout. It's probably going to work 30% of the time to buy the breakout. It's okay if you have good risk reward ratio, but you better be able to put your stop like down here, because if you have to put your stop at the low, 30 is not going to be good enough, right? But this entry or this pullback or anything in this area after they've retraced the wick, that's going to give you pretty good risk reward. But if you want the higher reliability, the more reliable trade, it's this one. The problem with this one, it's almost always just a scalp. That's the problem with that trade. When it comes all the way back here and bounces with an aggressive trader, you do not have evidence most of the time of whether or not this area is going to act as resistance or not. And a lot of times it does, just like this. So a lot of times this entry will not get past these trap traders a lot of the time, right? So in other words, it looks bullish, you close bullish on the bigger time frame, you push up to a target, let's say the Buddha range level or the channel high or whatever it is, and then you pull back into that level where the breakout happened, what we call the scene of the crime, and you get an aggressive trader defending the level, right, or reclaiming it. It's an extremely reliable scalp. When an aggressive trader is waiting there, they will usually push it at least 10 to 12, maybe even 20 points on the 15 tick. If you find it here on the 15 tick, you're going to get 2 to 3 bars, 8 to 15 points pretty often. Sometimes it'll break out again. And sometimes that breakout will make a new high. But this breakout is less reliable than this one. So a big secret to becoming a more reliable, higher win rate trader is to not be so greedy and to identify that this can pay you a lot of money. Because on the 15 tick, keep in mind, if you are entering on the star, let's say, your entry, or right after the star prints, your entry is maybe 39, what is that, 39? Your stop then goes under the star, so let's say 30. So you can even give yourself an extra point if you want, and we'll just to make it easier on the math. So for me, to do my math in my head when I'm talking out loud can be a little tricky. So there is exactly 10 points risk, right? To get 10 points, we need to get this to 49 to get the 1-to-1. And you can see that to do that, what you need to do is you need to print 2 up bars, 1, 2, and then at least 2/3 of another one. Whether or not this bar here closes bullish will not matter because you'll have already taken most of your profits. We're right there, right? To 10 to 12 points, sometimes 15, is what we should generally expect from these little scalps. And if you already know that more times than not, if this breakout does work, you get another entry anyway. Here, or on an apex trap back in. So this little scalp, like I said, 10 points with 1 contract of NQ. Again, I'm not telling anybody to, I'm just telling you what I do, right? Not saying you should go buy it or something, but that little piece is worth $200 for every contract. If you just take all profit at 10, right? And sometimes I'll get 12 or 15, but let's say 10, just to be sure. $200 per contract, and your risk was $200 per contract as well. So $200 might not sound like a lot of money, but once you can do this over and over and over again, if your win rate is really high, 60% plus, to get that 10 points, you can build your account and eventually take it with 2 contracts. Now you're just doing the same thing you're doing before, but you're making $400 every time because you can risk 400 without risking ruin, and you just keep hammering away at that little scalp. And that's a great consistent way to trade. It needs to look just like this. It's got to have a star. It's got to be bullish on the higher time frame. It's got to be at location, meaning you have room to the target, which is, like I said, either the channel high or some other apex high or something like that, like these little flags. If you have 10 points or more to your target, and you've seen shorts get trapped in a wick on a higher time frame, and you know the location that bar closed, or you can use where most of the volume is, but that you might miss your entry then. See, if you use the volume, look. So the yellow line is where all the volume is, right? If I move this to where the yellow line interacts with the green bar, this little dash there, that is where most of the volume is. A very, very good trade is to get a star that touches that line, touches the line, and then closes the star to the upside. It didn't reach it. And so you would, if you programmed that, you wouldn't get long there. You'd miss it, right? If you were watching it, you might be willing to make an exception here because it was damn close. And if you drew the volume profile, you might see that it was a high volume area, not just one. Here, I'll show you. So draw the volume profile of this, and what you'll probably see, let me make this a little more visible. A little bit of a tangent, but another good trade. So if you look at this, what you'll see is, as if that's imagine it's like a daily chart volume profile. Oh, this one's just one single price. So the problem here is that we had a low volume node above us. So if you look, I don't think I can bring that forward, but this volume like bump is not big enough to be seen over to the right of the candle, right? We don't see anything here, but we do see one right here. See that little? So it's not the VPOC, which is where the pink is, but it's still it's nearly that big. It's another high volume area or node, and what do you know? That's exactly where we came back and tested. And when you get a star, see that one? Got it. See, it didn't get the VPOC of the bar, but it came back as far as it could, which is the high volume edge. See where it went? It's the high volume edge right before the low volume node. The VPOC was just a tiny little bit bigger volume, but between the two, there's very little difference. They're both big spikes, right? Just like this one's a pretty big spike too. But they ran into the first big high volume edge, basically, tried to get through the low volume node and reversed. And that reversal happened with an aggressive trader on the DOM, which you can see on the footprint, or you can just look at the algo and watch for the star. But it's got to be located in the right spot, and then you need to have at least 10 points before the next resistance. And I'd say the primary resistance was the orange line, which is the previous day's open or close. In this case, I believe it was yesterday's close, perhaps. What was that? 13,450 was, let's see. Yeah, yesterday's close. Yeah, close enough. It's not yesterday's close, but it's very close. It must be the settle or something. Or the high. Is it the high? Yesterday's high. It's a little higher than yesterday's high. One way or another, it's usually previous day's high, low, or close. The orange is just like a candlestick based. I use it as a candlestick based marker, and so it might be a point off from the high yesterday. Maybe I just didn't align it right, but one way or another, or it could be like the settle or something. But it was an important level that I already knew about. So as long as I've got 10 points to that, that's where I'm targeting, and I get paid on that. And now the neat thing about this is that while I just picked that one randomly, you could literally do this anywhere as long as you know the direction. So look, and then I'm going to show you how to actually improve the. I'm going to show you how to improve the win rate even further. So let's just find a random another one. Okay, we're going to go here. We're going to erase all volume profiles. And we're going to just find another random one where it's bullish. And then we have a wick, like a bear bar, a wick below it that closes bullish, right? So let's just like back up to like earlier in the day. Just so I'm just going to kind of stop somewhere. We'll go to, it's got to have at least a couple bars in the day. See, this is Tuesday. It wasn't much of movement. And then Wednesday, we had some movement here. The only good one I see is the low of the day. And that I don't think ever got a retrace. So you would just miss it unless you took it right here, which isn't impossible. You could do it. If you see, that dip is this dip right here, dipping back into this move, right? And if you take the volume profile of this, it'll still work. I'll show you. It's not a great example because it didn't really come back. Like, we want it to come back later. This one just happened so fast that it's a little unfair because it's pretty hard to catch. If it's happening fast, it's kind of unreasonable. But it's still going to work out the same way because it pretty much always does work the same way. So look, if I mark off the low volume nodes, right? So see this, how low the volume goes here? Again, just think about it like a daily chart. So if you don't know how to interpret a volume profile, learn because you need it. So that edge is somewhere from here to here. I can't see it because it's behind the candle, but I can definitely tell that it's certainly no higher than this, right? There's a little low volume node there. So, and then there's an edge. It looks like there's a volume point of control from a previous bar, right? And they had some volume there. And that looks like that's exactly where it bounced. But we don't need the exact low. I'm not trying to find the low, right? I'm trying to find a spot where I can reliably get filled on a pullback. And so the spot you can reliably get filled on a pullback is probably the edge here, honestly. It would probably be wherever the edge is. I can't see it because there's a candle in the way. But somewhere in here, wherever that edge is. So it's either on the top of this purple or a little bit higher. And or a little bit lower. I mean, I just can't see what it looks like exactly. So we're going to go back there. I'm going to put a line where the pullback started. We're going to go to the 15 tick. And we're just going to do the same thing. So here's where this bar opened. Okay, so the green bar Again, it's a little tricky to do this in reverse. Once you've seen it enough times, you understand. But the green bar closes at 37.50. That occurred during this bar. The green bar is now closed, and if we have reason to believe that we want to be bullish here, whatever it is, if we have a signal that says, "Hey, we could be bullish," like on a higher time frame, for instance, what we want to do is figure out where do I want to get filled. Rather than just buying here, we can say, okay, well, where's all the volume? Oh, here, you know what? Let me draw it from here. Look, we'll just draw it from here. So the volume, let me change this. You can, well, because the other one, you don't usually have to do this twice, but since it's behind the green candle and it's filled in there, you can't see it. So look, we can just do it. It's the same range, it's just zoomed in. So if I look at this exact same range, what you're going to see is the low volume node. And I was actually pretty close. It ends right there. See that? And then there's another one that comes all the way down to here. And the obvious spot for the market to go back to is the volume point of control, which is the point where the most volume was done. And you can see that that continues basically until right about here, right? And then there's a low volume node here too, right? So we can extend these, extend drawing, extend the other, whoops. I think the other one is extended enough. And we would wait to see if we get a star in that area. Now, it might not set up, but we need it to tap that area and then give us a star. So are we buying that? No, it's not a star, right? So wait. Again, it might not set up. I get a green bar, and that's not a star. And that's not a star. There it is, right there. Okay. Did it bounce off of the area? Yes, it did. Right? It bounced off of the area. Did I get a star and a sign of aggression? I did. Right? They weren't on the same bar, but that's fine. That's not a problem. I got what I needed. I got a pullback into the area expected. They defended it. It's confirming that there's sellers trapped down there, basically. And then we got an aggressive trader, and most likely it's going to go higher. Right? How much higher? Well, it depends on whether or not this is the retest after a new high, or if it is the first pullback. This is the example. This example right here is similar to the one I said I would talk about, where you're looking for a way to catch the low. This is not as high. You won't always get this to work, and you won't always see the star. But when you do, because you have, see, look, on the higher time frame, this is like a low, right? It's a big drop here. So this is the low, right? Low, lower low. So you'd have to have some reason to the left to think that we would stop here, which on a higher time frame you could find with the volume profile and all that stuff, whether or not there's single prints or whatever. And if you saw what you expected, sellers drying up down here, if you look, there's like no volume down here. And then they came down. You might not be ready to buy the low, but when they close it bullish, it's like, hey, they dried up. There was no sellers at the bottom. And then they closed it bullish. If I get an opportunity, I should buy it as long as they defend volume. Well, they did that, right? They defended the low volume node. Oops. I can't grab that for some reason. They defended the low volume node, right? This, right? They defended it, and we bounced, and then we got an aggressive buyer, which is who I want to follow into a trade in general. In general, I want to follow the aggressive traders, especially for momentum trades. Notice we have not made, if you look to the left, this was the low, right? Not of the day, but like it's a lower low. It's coming off of a lower low. This one actually also looked really good because it had a lot of aggression there too. So I definitely like this trade. Let me just erase the lines. This is a lower low. It was bearish, right? Then we get the pullback. So this is similar to what I was talking about earlier, where it's not the low, but it's the biggest. It's likely the potential is there for the biggest swing of the day to follow. Are you getting the very low? No, but it's where all the money is, in my opinion, is here. Okay, if we go higher, right, and we pull back into that same spot where all that volume, the low volume node here, if we pull back in here and they defend it later, it may not make a new high from there, but there is a really good chance that it's going to bounce and you can scalp to the next resistance. So extend. And like I said, I don't think it ever comes back, and that's fine. You just have to remember that when you're getting it on this first retrace off a lower low, you just need to hold runners. But if it would have made a high and then came back and bounced here, I'm scalping it for 10 points back here. Now, it might eventually do it. Let's just see. I don't think it does. It's too late now. I wanted it to happen relatively quickly. So let me find one that's not at the low, and I'll show you it's the same thing. Okay, here we go. So again, I don't know how it turns out, but what you can see is it's obviously bullish here, right? Obviously bullish. We need some bear bars to set up a trade on the higher time frame. Okay. Otherwise, we're just aggressively buying any reversal that happens on the wick. Remember, you don't know where this is going to close. You don't know it's going to close bullish when it's live. You see a bull bar, and then you see what looks like a live bear bar, right? You need some bearish action, in my opinion, to get long. You need some bearish action on the higher time frame to get long in a situation where you want to confirm that you have trapped sellers. You need to see sellers try. You have to, in my opinion. So you want to see sellers attempt and then fail, and you want to see them fail and then see aggression follow them in. So here we didn't get the star. We got a green bar, which is good but not great. And then here we got another green one. So again, good but not great. So let's just keep going. You can aggressively take them. It's fine. You got the star way late, which is fine. You could take that too, but it's not as good as when it comes down here at the bottom channel. This is pretty risky. You have to think it's really bullish. So let's find another one. Like I said, I need bearish action. So here, bullish trend, bearish action. So on a smaller time frame, this is some sort of a pullback, right? And I'm going to get the second best thing to a star, which is a blue dot following a purple bar. And having an X on it and a dot on it makes it even better. So this guy is my primary entry as long as I am holding an important level. So how do we know it's an important level? Well, you have to know where the volume is, right? So let's look at this previous move here. And let's see where all the volume was before they got to the high. Okay, so this one is a little dangerous. The VPOC and the high volume nodes are up here, right? That has to be your target. That's your target. If you have 10 to 15 points to your target and you think it's bullish and you have an aggressive trader coming in, it's fine. But don't expect this to break every time on the first try. Okay, even if it's bullish. So that would be one way to get it, and then you'd see the aggressive trader come in. Now look where he reacted. If you look down here, there's that little bounce, and then below that there's like a little edge, and then the other edge is right here, right, and right here. So if any of those defend and give us a star or a dot or an X like this, that's the location that we want to see. Now, if we take out, if you're not sure about that, you can if the volume, if the majority of the volume from the move is above you, remember that that's going to be resistance. Okay. But what you could do is you could go back to the bottom and you could say, well, where was all the volume on the way up before we got up here? Where was the volume there? Well, I would probably take it up to here, and you'd see that the volume on the way up was here. Okay. So where do you think the market should bounce if it's bullish? Probably right there, right? Is it always going to do it within the tick? No. Sometimes it's going to get under it. Oftentimes it's going to get under it, look for sellers, not find any sellers, and close bullish. This dot says there's delta divergence in that bar. I wonder why. Why would there be more aggressive sellers in this bar that has most of the volume way down there? Why would there be more sellers in that bar than buyers, even though it closed at the highs? It should be relatively obvious, right? The market traded under the point where most people got long on this move up. During this entire move up, some people got long here, 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 all the way to here is where I drew it. That whole move up, the majority of the volume from that entire move, the biggest trader, if you will, was right there. Do you think the biggest trader might have like a reason to defend his position? Yeah, most people like to make money, and if you trade really, really big size, or if you have a ton of smaller size traders trading at the exact same tick, most likely, if the price gets down to that level and it finds no sellers underneath it, when it tries to test underneath it, and they're probably going to be buyers again somewhere in this bar or this bar. Like where exactly they're going to be, I don't know. But once I see that I've got the algo telling me that, yeah, there was potentially sellers, they're trapped at the lows, the location is correct, and the X is another sign of aggression. And then if you look to the left, we got an aggressive seller one bar before us. And so we potentially could what we call stuff this seller. It's a trap trade. A star would have been better, but an X and a dot is good. And so once we get volume, so you can this is the first entry and it's the best. Once you get the yellow volume line above the high of this stuffed X, the guy who's going to get trapped, once you get a yellow line above that on a bull bar, and the bull bar needs to be not pink, so this one technically is a little bit dangerous because they could still reverse it. But if you can get a bull bar, see how they're trying to defend it? If you can get a bull bar with the yellow line above this high, it's going to squeeze. So not yet. See how they can't get any volume down here? The volume is up here, but they're trading lower. What do you think? Is this maybe even a better entry than this? In my opinion, yes. You're getting a better price. Nothing has changed in your analysis. If you were willing to get long here because you thought someone was trapped and the buyer from before is probably defending his position, and as a result, the sellers gave up and you got to push higher. When they then give you an opportunity to add to your position or to get, if you skipped this one, and now you have an opportunity to get long with a smaller risk, should you be buying this? And for me, the answer is yes. And in fact, I will even add to my order all the way up to the point where they touch that low. And then if they take me out, like a point below that low, and then they reverse right away, I might even be, if they do it aggressively, I might even be willing to take it a second time. That's how confident I am of these entries, that you don't always get it on the first try, but if I skipped this one because I wasn't sure about it, and then I get an opportunity to get it for half price. I mean, look at this. What's your risk? Like, let's say you got in, like, here, 15, and you'd want to put your stop at, like, let's say 10. 5-point risk. Remember, your target is up here where all the volume is, so let's say you're conservative and you don't want to dip into that. 28 is what you're targeting, right? So that's more than 10 points, right? 13 points on a 5-point stop. Like, that's 3-1 almost. I mean, with small size, I might as well try it. If I was willing to buy it here, or consider if this bar is, once this one closes, anywhere in this bar is particularly on a pullback is valid. Well, then this definitely is, right? Will it always work? No. Sometimes it will stop you out. And if this wick goes lower than this, and then it didn't this time. I usually go like maybe a point underneath, so it would not have stopped me. But if it did, and it stopped me out, and then it closes like this, I'm going to buy it back. I'm going to take that 5-point loss, and I'm going to put another order in at 1850 with a stop at 10. So I lost 5. Now I'm risking 1850. And like I said, I will have that be my plan going into the trade, knowing I'm at location, I have a bullish higher time frame, I have a setup, right, that's valid, and I had a pullback opportunity to get it at a cheap price. There's, as long as I size correctly so that I'm not like blowing up my account by taking it again, as long as I size correctly, if I took it with one contract here, I can definitely take it with one contract here. Because even if I lose, I'm still not even 30 points underwater, which is totally I can make 30 points every day without too much trouble. So this time it just explodes and you get your 5 points back that if you did get stopped out, you make your 5 points back right about here. And if you want to take profits there, I think that's fine. It's better usually to hold at least for 10 to 12 or to your target, which again was 28.50. But holding runners in this situation, it's not wrong. You just have to remember that it's not always going to work. So here's something kind of interesting. If you look at what this looks like live, look how big these bars are. See how big these wicks are? What that is it is buyers getting nervous, including us, right, as traders, getting nervous about their position, not certain that they can get it to where they need to get it. And then it's sellers defending this previous sell. This aggressive seller is going to defend his sell. Now, where is his sell? It's actually primarily in the wick of that star bar. That's where most of the sellers are located. And so when we get sellers right here, when we get sellers, oh boy, well below that target, we can't let that influence our decision making. On the other hand, if we were up here in resistance and we get that same kind of sell pressure, in my opinion, I can adjust my plan to make sure I can get paid. But when I see sellers getting aggressive and buyers getting nervous, in other words, really big bars, as long as we're closing them bullish, we should actually be getting more bullish here, because whoever was trapped short here, whoever was trapped short there is still trapped, and they're probably more trapped because every one of these wicks has people trying to defend the sell side, right? And if they close bullish, the sell side's losing. So let's take a look at how that is how that looks on the indicators. If you didn't know any of this, but all you had is I just told you, look for this certain setup, right? This pattern. Take a look at what we have here, because this is a really good example of something I want to kind of go into a little bit and dig into here and look for elsewhere. On the %R, which is the yellow line, which I talked about a little bit already, what it shows is a parabolic breakout, right? Bigger than 45 degrees. It starts to go 45 here, but here it's bigger than 45 degrees, which means a down bar followed by an up bar, right? Like we talked about before. And then a nice solid 45-degree climb, right? That climb is climbing right into the Bollinger Bands, and those Bollinger Bands are expanding. See that? That expansion is your sign that a breakout is likely. So that expansion, which occurred here, see, it's still, both of them are rising here. So the expansion technically started back here at the entry. Once that next bar came, so after this one, here, let me move this so you can actually see it. If you look very closely at just this, right, you can see that the Bollinger Bands are rising, right? The Bollinger Bands were rising, even though, so price was dropping. The lower one started, this lower one's not dropping, and the top one's flat too, right? It's not super bearish. It's just a drop. It's a pullback. But they're not really building any momentum. Once we get the entry signal, that first bar, the entry signal, you got a nice climb higher on the %R, crossing the moving average, and then the Bollinger Band on the bottom started to rise, right? What we're going to watch for now is to see if we can get this top Bollinger Band to also expand and rise, and what would be better is if this Bollinger Band started to drop while this Bollinger Band started to go up. Because then what that's saying is they're expecting an expansion of range rather than a contraction of range. Because if they start to squeeze, then we're probably, the price is going to do the same thing, most likely. So what we see here is Bollinger Bands continue to rise, just trending up. That's really healthy for the fact that we're not breaking out yet. That's like the best we could expect. And then here is where the Bollinger Bands start to expand further. And look where the percent R is. It's getting exponentially closer to the Bollinger Band. So this is a breakout that's usually going to work. Notice I said usually, not always. But it's usually going to work. Here is the other really cool trick. By putting in addition to the Bollinger Bands, I've put a very long moving average that's weighted by volume. And what it ends up doing is it acts as a midpoint, like a zero line. Obviously, it's not a zero line. It's like sort of like a -50 line, right? Because it goes from 0 to -100. But it's like a natural midpoint that's going to shift with volume. So when you get when you get the percent R to get over that purple line, it's not a buy signal, but the idea is you've got more buy momentum here, and it no longer has a natural the sellers no longer have a natural defense against a breakout. Because if you look at spots where it has the purple above, like here, when you do get a breakout, there's a relatively high chance of a pullback following that breakout, because the purple line kind of acts as a natural spot for like sellers to defend. Once you've gotten above that purple line, especially when you're above the white line too, which says you're trending, momentum's to the upside, and we're above the zero or above the purple line, the midpoint, essentially, it's not guaranteeing a breakout, but the breakout is really likely, and it's especially good when this occurs before the actual breakout. It basically says that sellers are giving up and buyers are like on the way. They are expecting this to break, in essence. Whereas this one, they expected it to break for a moment and then they gave it back, and that basically guaranteed that it was going to not break, right? They ran into the Bollinger Bands. They were bullish, but they ran into this purple one too. They tested above it with a pink bar and they just gave it up, right? Whereas here, we're pushing over it with a pink bar, but you can see we're still rising and we've got room to the Bollinger Bands. And so as long as we don't lose that purple line and the white line, we are good at this point for this actual breakout to continue. On the smaller one, I know I've got the green here, which is a different, that's looking at a different time frame, but here the volume zone oscillator is clearly rising, very like at a 45-degree angle. There's no sell pressure in the volume. If you were watching the DOM, what you'd see is limit sells getting pulled and buyers mashing the hitting buy market buying, to the point where you're getting movement, the pink bars, you're getting movement up primarily due to sellers pulling their orders. So when you see volume zone oscillator rising with a pink bar, and especially if it's green, and then you've got all of this rising together, and then the Bollinger Bands expanding, the likelihood of this breakout working is really high. Now, the key is that zero line, once the VZO gets over the zero line, it needs to be defended. At any time, if buyers lose momentum, they're going to go back to that zero line and kind of like refuel, and that's fine. But someone needs to be waiting there to buy at that level. Otherwise, they're going to lose. They're going to give up whatever they just gained. They're going to eventually, the further away we get from that zero line, they're eventually going to need to pull back into it. And then kind of the same thing goes for the percent R. It can go on for a really long time, but eventually it's going to have to come back and test either the white line or the purple line most of the time. And sometimes it just flies right through it. But just realize that some sort of pullback will eventually come. So if you missed this breakout and it just goes without you, and you see the VZO just like climbing and the percent R is just like ripping, now it's stuck at zero, right? So it can't even go any higher, but you can see the moving average, they're crossing, everything's expanding and going higher. Like there's obvious, it's not the time to short, right? But you might not want to chase it unless you had some sort of a pullback. So like this, seeing this helps me know I can't short because we've touched or gotten really close to the upper Bollinger Band. The only way I can short this is if I have higher level location and a setup on the higher time frame, and I get divergence. So whoops, I accidentally moved this. So this, like, you could have actually chased that. It turns out that it just rips out it. It goes and goes and goes, which happens. But look what happens to the Bollinger Band. See how they squeeze in here and eventually just like get like lost at the top, right? Don't chase this, in my opinion. You're going to need some sort of consolidation here. It can keep going, right? But this is the most dangerous because when it reverses, this is likely to get retraced. When it's going to happen, like, you don't know. Not on this. You're not going to know on this time frame. What it really tells you is that you should be trading a higher time frame. If you've got no information here, you need to jump up to the higher time frame and start to make sure that you have something to go on. Like you can see here, even on the 24 tick, it's like it's squeezing up to the zero line. It's overextended, right? On the 40 tick, what's happening? It's squeezing into the zero. It's probably overextended. Should I short it? Hell fucking no. But if I see some divergence on one of these time frames and the VZO falls back down under the zero line, and then this falls back down and starts to like wiggle and maybe make a divergent high and fall down, then it's time to short. But do not short this. And if you're going to chase it, be quick about it, because all it needs is one of these lows gets taken out and we're going to have some sort of a pullback. Now, you might get a chance to buy that pullback, but you don't want to be the first one. So like here, don't buy this. Okay? Don't just buy it because it's a bearish bar and you've got like a big squeeze breakout. Don't just buy it. What you want now is to watch for the reversal, in my opinion, or to see if it sets up long. And you can't get long if all you have is a drop from the top. There's nothing to do here. There's no divergence. There's nothing. So you just wait. And yes, will you often miss the top because of that? Sure. But if you want to be aggressive and sell every single one of these bear bars, you're going to get hosed eventually. So I would just recommend, unless you have a location and a higher time frame reason to do so, you know it's going to turn, but don't waste your time and money because you're going to have a much higher opportunity later. And it might be lower in price, but the consistency is going to be way better. So now I'm looking, like I said, for some sort of divergence. Here, it's just a straight drop, right? So I would need another high and or another low to develop before I get a trade in. So I'm not even worrying myself with this V bottom, the V top. I'm at this point just saying, I'm so glad I didn't chase at the top. I'm going to, go to the restroom. I'm going to go get a drink because I've got nothing to do here until they make a low, a high, and then a low, or a divergent high for the short. So here you can see we made a lower low, and then this one bottomed out at zero, right? So the only way I could be bullish now is if we made a divergent low, because we've already gone into the lower Bollinger Bands here. So my guess should be that the next move is probably going to be bearish. Plus, look, we got underneath the purple line again, so that's kind of going to be a natural resistance. And so we need to get above that little resistance, and I need to get the red line above the zero line to really think that I could have a high odds set up. Now, in the higher time frame, you can see it's very bullish, right? But we wouldn't know about this close until 13,378. So this is when we know that this closed, right? And you can see now we've gotten above the white line. We've at least approached, if not gotten above the zero line. It's looking like it's probably going to lift, right? So I want some sort of a pullback if I'm thinking long, but I need a target to do that, right? So if I got some sort of a pullback there, I could potentially have a long setup, but it looks like it's just going to V, and that's fine. I'm just skipping all of those, right? And I'm totally cool with that. So here we make a lower high, but here we made an equal or higher high, right? And then here we topped out at zero at the same, for both of them. So there's not really a divergence there. But more importantly, we've crossed below the moving averages, both of them, right? and you can see that the Bollinger Band is trying to expand. So there's a chance for a breakout here. So like I said, because it hit the lower Bollinger Band, the yellow line hit the lower Bollinger Band, my preference is short here, but it did hit the top Bollinger Band as well, so I would need divergence, which I have. I've got divergence here, so I could take, that would be the first short opportunity. If you have a good location, you thought you were short on the higher time frames, you could take the short there, and you get at least your 10 to 15 points. If the higher time frame looked long, I want a star, and I want that star to show up on the smaller time frame at the location where all the volume is, right? Just like we did before, it's the same thing. So I'd go back here, I'd say, okay, where was most of the volume on the way up? Well, most of the volume on the way up was there. So that's my primary location. What if I include all of the consolidation? Where is the volume plus the consolidation? It's up there. So, and then again, I could zoom in here and see where the exact high volume edges are, right? But what you're going to see, what you're going to see most of the time is that if you mark off these edges here, 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 and remember, you knew about that, while you're just hanging out, and you say, look, if I can get, I think it's bullish, if I can get a divergent, particularly divergent low in there, or hidden divergence, and it produces a star, I should probably take it. But I need a target. I need a reasonable target. So what you get here is they test underneath this, remember, which is a low volume area and a high volume edge. And then the close is back above the high volume edge. The problem with this one is you've got the VPOC right above you. So in my opinion, I don't love that one. And I also don't have any divergence. It's just a higher low, right? So that one's like, it's okay. And it might work, right? Then we get a pullback, we get a green bar. If this would have made a lower low on the indicator, but a higher low on price, that's a good entry. Otherwise, I'm going to skip it. But it did come back into the VPOC. See how this VPOC, we defended it right there? See how all the volume, if I draw a line over that pink VPOC, all the volume, it was right there during this consolidation. See that? How they can't get the yellow line to go below it? So you certainly don't want to be bearish. And a green bar is an okay entry, especially after this star. So if you didn't take this one, because you weren't sure if it was bullish, this one becomes pretty good. Whereas if you did take this one, then this just says hold. But it would have been better if it was divergent. So let's see, does this one gives you divergence. This is the better entry in my opinion. See how we got a lower low on the indicators, but a higher low on price, and we're still bullish, right? Everything's still bullish. You're not way far away from the purple line. You're like right at it, right? You're holding the 0 line, but you're making lower lows on the indicator, and you've got higher lows on the 15 tick, and the bigger time frame is looking bullish. This should look relatively bullish, and like I said, if it is a divergent low here, even better. And then the divergent low here is great too. So all those things are in my favor to go long, and so this becomes a pretty consistent place to buy. And you get your scalp, 20 points maybe, but then like I said, whether or not you get more or not is going to depend on your higher time frame. If you had a level here, like I had the voodoo range level here, like I'm not going to press my luck. If we can't get any volume developed above that target, I don't want to stay in the trade. And then if I see a star come off of that after rejecting at that level, like I'm going to start looking for trades to the other direction, But if you don't want to be aggressive, you could say, okay, I think it's probably not time to be bullish anymore because I shouldn't see this if it's bullish. So instead, I'm going to wait for a bearish entry. And so to get a bearish entry, what we need is a breakdown below the purple, which happened here, and then a breakdown below 0 line, and then an aggressive trader. So we're almost there. We just need to get under the 0 line, and then get an aggressive trader. So there's under the 0 line. So if we can hold that, pull back, and then get a star down, it can set up. It needs some kind of an aggressive signal though, and the only thing we get is a dot. Let me just see if I had it on a higher time frame. Not really. No, this was your best opportunity, and it's like I said, that's how the shorts go. Sometimes the aggressive guy gets what he risked, what he risked for, and then everyone else needs to either chase or just have some other way to get in. And like I said, that's pretty dangerous, but it works because if you look, you can no longer get bullish hidden divergence once this low gets taken out, right? Because even though you've got a lower low on the indicators, you now will also have a lower low on price right there. See how that close is lower than this close? And the indicators are now just trending with the price lower. And you've got all of them going down, and this one's approaching the Bollinger Band, and it's expanding. So if you have a reason to get aggressive here, you can do it, right? That pullback into the dotted line is good. The dot definitely helps. If I knew where all the volume was here, and I saw that we got a retrace into it, that would be better, right? But it doesn't always retrace. Sometimes it just drops. But if we get back up into there, that is a location that I'd be looking for. Okay, so it goes back up there, right? And do sellers defend it? Nope, they don't. So do I short it? No, there's no reason to short it, right? It came straight down, it V'd back up. I didn't have any indication on this time frame that I wanted to be looking for a long, and so I just missed that move. And I'm okay with that because I don't have a high odds way to get it, right? And then here they make a trap back in, so it's aggressive, but the location's right. That's overnight high, and you got to trap back in on overnight high through high day or through the Voodoo range, whatever that resistance there got over it, and then it gave it back up. Now, I'd want to see it cross one of these lines first, otherwise you risk getting totally slammed. But the location's right, so if you want to wait for the triangle, at this point, you've gotten underneath there, you're at least headed for the zero line, and you've got a lot of room. Like, this isn't very choppy. It's like it's moving in big ranges, so chances are you're going to get a couple more bars. See that? At least enough to get your risk off. But nope, when they can't get under the zero line here, you have to be prepared for it to bounce. See that? And what do? They give you another trap back in, right? Trade behind, collect liquidity. That's the better entry. Collect liquidity, come back on a star, and look, divergence. Divergence. It's flat or lower, and this clearly went higher. That becomes your better trap back in, and I can take it right on the star. And I realize that sometimes it's going to take 2 tries, and I'm okay with that. Because when I get it right, it pays me, right? So here, if you put your stop 1 point behind this, it might have gotten hit. And that's just reality. 415.75. Yeah, 417. So if you only used 1 point of cushion, you get hit there, right? But when it comes back in, and like I said, Simon suggests using like 14, and that's one way to do it. You can just use 14 points and you're probably fine. Let's see. If you got in right here and you didn't wait for a pullback, oh, I can't see what that is. Let's say you got short at the Voodoo range level, 405, right? That's 12 points. You'd be okay with 12 points of risk. You'd have 1 tick. You'd go within 1 tick. Simon recommends 14. I do things slightly differently. I go 1 point behind the high, and then if I get ticked out like this, I get back in. If it comes right back at it, I'll just take it twice. I would rather take 10 points and then get paid 100 or whatever than have to take a bigger stop and then not know whether or not I can risk taking it again. See, because by taking only 10 points of risk here rather than the 14, when it does stop you, like if you took this one with 14, right, and it stopped you, like here, this is my issue. That's your stop. If your entry is 0525, right, or 05, let's say, and your stop is 14, right, or actually no, it would be, you would have survived because this went to 15. So if you had the 14-point stop, you survived the first one, right, because it's 05 to 15, and then you survive the second one. So with Simon's method, you can get short here, here, or here, and you don't lose anything in this scenario, right? And that's nice. But sometimes it gets a bigger wick here and then stops me out with 14 or 12 to 14 points. Like if I would have only had a 10-point stop on this one and I was aggressive and took it, I would have gotten paid. Keep that in mind. Like I'm taking profits here, so I'd probably only lose maybe 5 points of risk. Like I'd take probably 10 off here, 10 points. I'd take a contract, so I'd take half off, and then I'd lose 5 on one, right? So it's like, or I mean 10 on one, so it's like 5, net 5 down is what I'm trying to say. I might be net 5 down if I took 10 points on one contract and got stopped for 12 on the other one. I'd be net down maybe 5. And I'm okay with that. And then, like I said, if I wanted to take it again, I could take it here, and I may get my 10 points, I may not. And if it takes me out, so be it, right? And then I'd have to decide whether or not I want to take it a third time. But you can see that if you didn't take it a third time, you could miss this entire thing, and that'd be pretty frustrating. So Simon's solution is just put a 14-point stop on it, and you survive more of these. My problem is if I got hit with a 14-point stop, how often am I confidently taking these other trades when I know they work, but I'm scared of losing another 14 points? If it's enough money to make a difference to you, the difference between, $200 and $300, if that's enough to to shift your decision making out of what's optimal, you need to find a different method. And for me, seeing that negative 300 per contract, I was trading 2 contracts, so I'd be down like almost $600. And there was just something psychological at about $500 where anything more than that, and I felt like I must be doing something wrong, which isn't true. But in my mind, taking that 14-point stop, on the 2 contracts, it just stung a little bit too much. Probably because I sized up from micros to minis kind of fast. And so, like, for me, like, a $550 loss or whatever still kind of feels big. And then I would get rattled if I took it a second time and it stopped me completely. And all of a sudden I'm down like $1,000. I missed this trade, like, often. Now, again, in this scenario today, Simon didn't get stopped at all, right? And I think he got short here, not here. So, like, one way or another, it either way still works. But for me, if I want to be aggressive and I'm willing to take it 2 or 3 times, like I'm confident about the location, I know the setup is good, it's valid, I should take it every single time it sets up because I know it can produce really consistent trades, at least to get me 10 to 20 points, if not a huge roll down. The way for me is I go to the wick, I go one more point than that behind it, and if I get ticked by a tick or two and it closes back in, I'll just take it again, because even though the result for me here is lose 20, well, no, it'd be lose 15 really, because I'd lose 5 on this one, let's say, and then maybe I'd lose, because I'd take profits, and then I'd lose 10 on this one, so I'm down maybe 15 points, but I'm confidently getting back in again, because I'm not down $1,000, It's just like, I in my mind, it's like I can easily make that up, and so I can continue to trade on process, get short here, and make back, my stop right here, and then take the one off and leave the other one as long as possible, right back to a target somewhere, preferably on a higher time frame, like this blue or this gray line. So like I might target this would be very normal for me. If I see that level, that gray level in the higher time frame get defended like that. So once I see this, if I have anything more than 1, I'm out of everything but 1 there, and my stop is behind that bar. So my trailed stop goes here, and I'm trailed out, right? But realize that if I did it here at, like, let's say 44, right? 44, yeah. And if I got short at the trap back in, that's 08. Right? So, I mean, 70 some, right? Almost 70 points. Like that. Yeah, that's good. And even though it's only 1 contract, that's times $20, right? So here I'm complaining about a $500 loss, and then that one contract makes me like $1,500. And then if I took 3 contracts, and I got paid 10, 50, like if I took 200, and then when it got 50, I took another contract off, and then trailed the stop to here and got like 15, 14, whatever that was, 1,400 on the last one. Like I've already got like a $2,400 day, and like on that one trade, right? Even though it took me 3 tries. So if I'm going to be aggressive, that's the way to do it. What I personally prefer, though, is to wait for the divergence. So simply by looking at the indicators and seeing on the way up that we had a high here. So we had a high, right? Then we had a higher high. This one it's still going higher. See how the Bollinger Bands are still expanding up here? I'm going to skip this one if I'm unsure. If I have location, I might take it anyway. But I don't have a clear reason to get short here because I'm not clearly divergent, and I definitely have not broken down underneath the 0 line, so it's risky, right? Even here, you haven't really broken down the purple, you haven't broken down the 0 line. It's just going to be riskier. And then when it traps back in the first time, now there's clearly divergence. And now I'm approaching the 0 line, and now I've broken down below the purple. That one I'll take, right? That one I'll take. To the short side, sometimes it takes more than one try. Sometimes it happens on the long side too, but the shorts are always harder. They F with you way more on the short side. So here, you can see they continued to go higher high, and then here, lower high, right? So they're continuing to run out of gas, but sellers just aren't pulling the trigger, and that's why you're getting pink, all the way up to the top. And that's a big red flag at the highs. If you get pink, and then a shift down, like a purple or whatever, like it's different if you got another bar in between. It's like at least there's some buyer trying to defend there. But here, you had a buyer here, and then you just have sellers giving up, and when they got to the new high, there were no buyers, right? So the chances of that turning around are higher. And anyway, so that's that. So I was talking about the scalp, though, because that's another example of the reversal, and why that's a good example, though, of what I was saying before, that just because I missed the quote-unquote high, oh, I guess I don't. But even if this was the first entry, right? And skipping that actually makes me more money. It protects me if I wait for the divergence. Even though it might have just done this the first time, as long as you can handle the missed opportunities, it's for me, it's the better way to trade. So I don't think I did this one. This is the open. Okay. So here's the open. It dropped first. Here, let me show you. So today's open. Okay, here it is. I thought it started up. All right, so the open was in here, right? We were already lifting. I know that ring bar followed by a white triangle up, especially at location, is usually pretty good as long as we are at a place where someone else had traded previously. And I have that right here, right? So someone bounced the market. Whoops. They bounced the market. It came back into that location, and here too, right? So if I mark, too many things here. Okay, if I mark off this first low, so this swing low, what I want to see is ring followed by triangle up in there, and I want this low or this low, whichever one is lower, I want it to be defended. And as long as it is, I want to be getting long. Do I need to buy right here? No, I can wait until I get the pullback into the location where all the volume was, right? So I can just do the exact same thing I did before. You get a big rip. I didn't trade that. Some people did. like it's set up, but like I'm not just gonna buy like the first move. But what I will do is I'll see where all the volume was, and it happened to be at the very lows, right? So all I have to do is basically say, look, if I care, let me change the color so you can see it. And say as long as that low is defended, and I get a star, if I get a star that comes off of a high volume edge, here, here, especially here, right? If I get one of those spots to produce a star, it's no, not a star down, a star up. That would be preferable, right? I'd like some kind of a pullback here, but then I also want to watch my indicators because I can see on the higher time frames at this point. At this point, I can see on the higher time frames. Sorry, let me go back to this start. So, because otherwise you'll see extra bars. I don't want that. So at the open on the higher time frame, right here, this one closed at 71. This was so you didn't know that was there. At the open, it was this bar here. Okay, the star bar is that's the first open. So before the open, yeah, this is where the open started. Is this star bar? It's way at the highs. See the channel? We want to see bullish stars at the bottom of the channel, not at the top. This guy is at risk of getting trapped, right? But we don't know he's a star until 13,405. So if I put that there-ish, that's where that one is confirmed. Okay, so as you're going higher, this is where the star prints, right? So we got the entry signal. If you wanted to be dangerous and aggressive, you take that. It comes up here, and the higher time frame prints a star at the wrong location, at the wrong side. So either the price needs to explode higher. It is at yesterday's point of control, but it needs to explode higher now, or it's probably going to trap longs and retrace most of this. Where will it retrace? Well, it's fractal, right? So we can just draw the volume profile of this entire thing. And let's stop before the new one. Let's just go to, I mean, I guess you could do it to here, but let's do it to here and see. Yeah, good. So it's down here. So now I can, here, let me change the color and we'll take a closer look. And we can say on the higher time frame, where do I expect buyers to defend? And you can see this big low volume node in there. See that? If they defend the top or the bottom of that, like, it'll probably work, right? What about this one? Well, if this defends here, you might be okay, right? But down here, if they let this go and you get under this, that blue dot is aligned with this for a reason. Okay, just like this blue dot is aligned with this one for a reason. Where the yellow line is going to align most of the time. So the cheating way to do it without drawing the volume profile is just put a line at the dots. if right, that's the easy way. But so if I put a line here and I say, okay, if I can get a star to bounce off that level, or maybe wick into here but then close above that line, that might be a good place to look for a bounce. But if you look at this, we've already gone all the way across the channel in the higher time frame. We printed a star at the higher time frame, and we tried to expand, and now we've actually returned to the channel and printed another one. So really the right way to interpret this is you would go to the higher time frame from this, and you'd say, is there a reason, like location wise, for all this expansion, or are we running into resistance? And on the higher time frame, what you'll see is we're actually running into some resistance. So the more likely setup is going to actually be to the short side, but we need to wait. We would need to wait for a triangle down basically to confirm it on the higher time frame. But if you wanted to look for the long, because even the time frame even higher than this was long, then you would look about at this white dot. So look what happens. We break out, right? That's where the star is printed. We know to be a little bit cautious here. They put a star down, they trap it. If the sellers take this back, it's bearish. Okay, because they put a star there, They aggressively got short, and the market ripped higher. But look what happened to VZO. Right? So we've got less aggressive buyers, yet the market is trading higher. And we had an aggressive seller here get stuffed. Right? So the expectation should be higher. But if we get lower than this, we have divergence, and we've got what's called a reclaimed aggressive trader, and the potential for a big drop is possible. And my target would be back here. So they try again. See how it's still divergent? Right? We do reclaim this. Come here. I don't know why I can't grab this. Too many lines. We do reclaim that with an aggressive. So that's a good short. Note here, we're going under the 0 line. We've already crossed the purple and the white. It's going into the Bollinger Bands, and the Bollinger Bands are expanding, right? It's a good short. So that is the first setup. And then it triggers again here. Note we've rejected the neutral zone, and we're staying in the oversold zone. That usually means it's a trend down. Once we get to 71.50, which is one more bar right here, the higher time frame gives you a star down. That should, if you're looking for a long, you need to stop looking for a long now. And realize that the better opportunities are going to be on pullbacks to go short. Where do we want those to set up? We want them to set up wherever most of the volume was. This is going to start to look a little tedious because it's literally just the same process over and over again. Where's all the volume? I'll show you. All the volume was here. So we'd like a setup that defends this to the short side. See how the dots are aligned? Now this one's kind of wonky. That one's not so good, but the rest of them are aligned pretty nicely. So we'd want to see a short that comes back up and rejects this and then aggressively leaves the area, right? Such as this. Right? See how that's where all the volume was? And they can't get through it, and instead they aggressively push lower. So that's the breakout you want to take. And note this is already an oversold. That does not mean it's going to come back to neutral, especially when it rejects neutral. And now that we've gotten flatlined with everything, remember that all it's going to take is one move for the buyers to retrace some of this. So in my opinion, you start taking profits, you start high-fiving if you were short, and you stop shorting because it could reverse any time. Some people are fine shorting this. I'm not. I'm not one to short in the whole. I feel so stupid when I sell this, and then it just goes boop, right? And this is when it does that. Now, were I short here like I was supposed to, I'm definitely holding at least until I get a buy bar. So this buy bar here, right there, right? Note where it is on the higher time frame. You had all of this volume here, and then a low volume area in here. And the dot is here, and we haven't reached it yet. See that? So they're defending this, but on the higher time frame, we really need to get back into this shaded area to defend this low volume node. So I don't want to be super bullish until I get back into the blue. So I need to get back to here before I really think this whole thing is getting retraced, personally. Note the bottom, this is just flat line to the bottom. So it's probably going to be a wide range or continuation lower, and you could get short on divergence with an aggressive seller. But remember, it could just reverse because it got so flatlined. The potential is for a really, really wide range. And if you want to be aggressive and buy this for 10 points, more power to you. Do it, but realize that when it doesn't work, you're gonna get hosed. But if it's gonna expand in range, it's gonna expand when these are flatlined, and then it bounces. And this is why I said don't short this, because all it takes is one buyer, and this can happen in like 3 seconds, right? 42, 26, 42, 51. So this whole thing happened in 30/10 of a second. No, 30 seconds. 30 seconds to go from here to here. So do you want to be shorting this? I don't. I don't want to see all my profits go away in 30 seconds. So I don't do that. But if you know where the close is going to be of each bar. So if you just want to put a buy order at wherever the close would be on the buy side and get triggered in here and get your 10 points and get the heck out of there, I don't hate that. I don't hate that at all. Just be, smart about it. So now notice we made this huge sweep from oversold all the way to overbought. That is usually followed by consolidation. So here I was expecting big range, right? And that's why I said this could be a big scalp opportunity, but you got to be quick about it. And basically, if there's a sell bar, you just get the heck out. Now I am expecting consolidation, so I go back to what I was doing before. I'm waiting for divergence, and I need that divergence to be natural divergence if I'm looking for a long. That's just the rule, because I'm trying to go the opposite direction of the trend. And for the sell side, I want to go back to wherever there was volume. But remember, I said if we could develop volume back into the blue area, it might be bullish. And if we put a bull bar there, these are pink, so it doesn't really count. But now we've put buyers with volume back into this area, and based on the higher time frame, that suggests that we've defended this low volume node. So now I'm really not interested in looking for shorts, right? And the only way I'm going to buy this long is if I'm aggressively getting, like, I'd need a stop market order to get in here because it's so damn fast. This literally occurred like within the first 10 minutes of the day, just like zoop, right? So just realize it might look easy, but it's not in real life. So am I going to short this? No, because we've already defended a high volume edge and a low volume node on the higher time frame. It's bullish on the higher time frame, right? But where are the sellers on the higher time frame? They're here, right? At the top in the wick of the star bars, always. So 13,390 is where I expect sellers to show up. I need my target to be under that if I'm going to be a buyer. Okay, that's very important. I know we're pretty far from there, but it also means that the sellers might try to defend that area. So what I really want is I should expect consolidation, and I want some sort of divergence. So I'm not doing anything here. I'm kind of expecting it to go higher. I just need a setup. So we get out of we go back into the low volume node on the higher time frame. Okay, so now we're going to remember what we talked about in the beginning? Bear bar, wick, bull bar, right? This is the same setup. I don't remember if it's the one we did or not, but I can do it. So where's the wick end? It ends at this close, right there, right? That's the wick. Oh, sorry, I did that wrong. No, I didn't want to see that. The wick is that's not right. It's the bar above it. This one. There we go. So that's the wick of the green bar, right? We don't know it closes green until it closes. But if we're watching this, the gray one closes, it goes here, right? Here's where the gray closes down here at the red. Gray closes here, right? And then it tries to go lower, then it comes back up, and that produces what will be the wick for the green bar, but we don't know if it's going to be bullish or bearish on the higher time frame at that point, right? So we look here, we say, okay, if it's bullish, and it is, and we've potentially put a wick in underneath a bear bar, if this turns bullish and closes at 71.50, which is here, okay, then this is the general area where I want to be getting along, but I want it on a pullback, right? Which this should sound familiar because it's the same thing we did before. So we get some sort of a pullback is what I'm looking for, and then what I want preferably is a star or a blue dot. So this is really the only one that showed up during the bar. And again, where do I want that to occur? I want it to occur. I don't remember if I did this one or not. If I already did this, I apologize. Oh, let's not include the consolidation. So there's obviously some trap buyers up there. Right there. Okay. So that's where all the buyers were on the way up, right? And if you want to be more specific, you could find, come on. You could look at the actual volume profile, because sometimes there's more than one high volume area, and you kind of want to know where the edges are. So you can see there's a low volume area right here. This one needs to be defended, and then there's definitely one right there, right? And then everything else in the middle is basically high volume. So what I want is a bounce off of there that produces a heavy, an aggressive buyer, or some divergence, which happens right here. See how they, oops, see how, I hope this is making sense. Shit, I can't grab anything. There we go. See how it comes in to the low volume area and it defends it, but it closes bullish? And see how you went lower, but on the indicator you went higher? Like, it's literally the same thing, just a different time. and you don't, that's it, it's kind of as easy as that. And so you know where you're looking. You want a bar that touches that. You know what signals you're willing to take, a star or a dot, or maybe a green bar if you're really bullish. And then you need location, which is at one of these lines basically, or at a high volume edge on the higher time frame, as long as it's bullish, right? And then I need divergence, which I got on both of the indicators. That makes things way better and potentially gives me a move up, right? Like out of here. And so now remember, this is an example of, like I said before, this was the low after a really big drop. We have nobody above us trapped, right? We are getting in at like the bottom third of price action. This is where the day started. Let me erase the lights. If this is where the day started, right? This is the high. This is your low, right? And if I extend that a bit, your long, my long here on the dot, it's at the lower third. See that? It's not near the high. So that is not a scalp. This is a swing. It's the same setup, but it's a swing because there's been a big pullback, a reversal. Did I let this bother me that I didn't get long here? No, I just let it go, figured out where all the buyers were, and decided that if they come back in there and they defend it, especially if they trap somebody, I will get long. Now, if it pulled back again into this zone, can I buy it? Yeah. So you could add here if you want. If you missed this, you didn't have your order ready, and you see them pull back into it, guess where my stop goes? Right there. You can take pretty big size there and still risk the same amount. Right? If you risk $500 per trade, I could probably take like 6 contracts here. Right? If I wait. Now, sometimes I'll miss it. It won't fill me. But if you get that opportunity and you know where the stop goes, it goes underneath that low, well, then you can try it. And again, my stop, I know if I need to price it right, that if I get hit and it comes right back up again, am I going to take it again? Yeah, because it's a swing, right? I expect to be paid way more than 5 to 10 points here, right? Now, did you have other opportunities to get in? Totally, you did. You just need to know what they look like, right? So if you've got dots, and you get underneath it, and then you get back over it, and you get a dot. Oops, the dot. That's a momentum trade. If you get small pink bars when it's really bullish, that's a momentum trade, right? All of that you can add to your order. you can add in these spots. A small pink bar with a white triangle, momentum trade, as long as you're going in the right direction. Right? And you have to think, now, again, once it flatlines, am I buying any of this? No, I'm not touching that. I'll hold until we get a bear bar, but I'm not buying that. I'm done. Once they've flatlined here and the white moving average is coming up and this is coming, I'm expecting this to roll over, right? There's no reason to exit until here. Not even a bear bar. How much am I risking if I wait, right? We talked about this. 15 points up, 15 ticks up there. Right, so that's 15 ticks, and then to close, 15 ticks, 30 ticks. So I'm giving away less than 8 points, right? Less than 7 to 8, 7.5 points. I'm giving back 7.5 points for the opportunity to make how much more? If I decided here, right here is where things start to get a little bit scary, right? Where it starts to turn pink and everything gets tight. So if I was nervous that this might reverse and I want to get out here, that's 82.50. If instead I wait for the first bear bar, 82.50 to 12.50, right? It's another 30 points, let's say. And what am I giving away by waiting for this rather than getting out at the high here? Right? That's the other thing to think about, because you really have to imagine yourself actually making these decisions in real time, and to recognize that yes, giving away, how much is this? 22.50 to 12.50. Giving away 10 points here is worth holding here, because you get 30 and you risked giving back 10. You don't know where the 10 is going to be, but you got 30 more points by just agreeing that I'm okay giving away 10 points from the high. And so if you picture yourself seeing a high put in the market actually turning around and giving 10 points back, which again is what normally we would risk, what I would risk on a regular trade. If I see that and I'm like, okay, that's what I was waiting for, now I can exit. But all this way, whenever we're making like 6 point, 8 point, 4 point, 3 point like turns, right? You're just getting these tiny little wicks. I'm chilling. I'm not getting nervous. I'm not worrying about it. It's just 8 points, 8 points, 8 points, 8 points, 10 points, 10 points back, done, right? Could it go higher? Yeah, totally, right? Totally could go higher. In fact, when I see this squeeze like this and then it expands again, see that? Right? When you don't know if this is going to immediately reject or if it's just going to bounce, but this is the point where I can make my best decision, because after this point things are going to speed up. Once you get this release, either you're going to go exponentially higher and just squeeze the shorts out, or you're going to V back all the way down, right? And then the only other option is go down to a important spot like here or here, right? And just like consolidate in there. What will we see if we should expect consolidation? We should see the entire range get taken on this VZO. So look, again, the other one wasn't a perfect example, but I'll show it. This is where your opportunities are. So remember, big move from oversold to overbought. What should we expect? Mean reversion, consolidation, an entry, right? There's going to be a trade entry on that pullback, right there. If you're lucky, during this, after that big move, sweep, what I call sweep of the entire range of the VZO, you're going to get an entry. Now, it also is the spot where you got above the zero line, which is really helpful. Then, same thing here. Swept across the whole range, right, of the VZO, all the way up to, even goes higher and higher and higher. Like I said, it can keep going, right? There's our point where we got all the way up to the top. Now we watch, does it mean revert? Can it get back into green, or does it keep going? Well, if you think it can keep going, there's your entry. Did you have divergence? You made a lower low on the indicator and a higher low on price. Technically, it's valid. Are you still in overbought territory? Yeah. It's still bullish, and it's not mean reverting. It's probably going to go exponential. Sometimes that breakout's going to fail. Usually it's not. Usually you're going to get another one. Not always. You can see now we get divergence to the downside. See how now it's coming out of overbought? I'm getting the orange to warn me. This is all going down. If I was long here, I don't want to be long anymore. It's looking weak, right? So any low that gets taken out now, I'm done with it. And in fact, just coming down here and bouncing off of the Bollinger Bands and then returning to the white or the purple and bouncing is a sign that we're not trending anymore. So see how it's bouncing between Bollinger Band and the zero? That's potentially still trending. But Bollinger Band to white, or white to purple, or purple to white, right? If it bounces here, that's usually consolidation, just based on how the percentile works. And then if I have consolidation plus divergence to the downside, it's at least resting. It doesn't mean it has to reverse, and it doesn't mean we should short every single triangle. I mean, every single star or triangle. But we definitely shouldn't be shorting until we see this. So now that we've gotten back in here, if we want to watch for this to drop below the 0 line and make sure that this has a chance to drop below the purple, we could start taking stars down, right? So we get below the purple, we get an X, not a star. That's too bad. This is the star. That one technically is an entry if you didn't mind the fact that you might be risking continuation. Now you've gotten underneath here. Sorry, the orange is kind of too bright to see, but so that one is really where you want the star. But an X is the next best thing. It's still a sign of an aggressive trader. It's just not quite as good as the star, but it's the same idea. If we get a trap back in, it's usually good. So in this case, that was a trap back in. So see how we got behind it? We got behind a star, and then in one bar, the very first, the next bar is bearish. Back into this bar's range in one bar, right? Broke behind it, and then bearish. That's usually a good entry if there's divergence. Will it always work? No, but it's usually good. And now this one, not surprisingly, it sets up a second time. So if you had a really tight stop on this one, it would stop you out, and then I would have to get short again. Note we've gotten underneath. We're rejecting the 0 line. There's no reason to be bullish here, in my opinion. And if you got stopped out, you got to accept that you might have to try again, but then you're going to make your money back when it comes back through, right? Pretty sure we did that one, unless that just looks exactly the same as the other one. But that is, in a nutshell, how it works, in my opinion. It might have been this one we did. We did something very similar. Let me see if I can find another scalp example, because they're, like I said, they're super reliable. They just don't always continue. So I might have to go to a different day. But we had some choppiness today. So I need to make a high or a low, and then to come back into that area and then bounce off of it with a star. So okay. Oh, is this the one we did already? I think this is the one we did already. But pretty sure this is the one we probably did already. And then it ripped. That is what we're looking for. Let's go a little further and see if I can find another one. Maybe one to the, I didn't do one to the downside. So we make a low, right? Big low. Should we be looking for swings or scalps to the upside? Swings. What do we need? Divergence. There it is, right? Whoops. So most likely there's a good chance that a big reversal could be coming. To get it, we need to get over the 0 line, over the purple line. Well, they already got over the purple line. They're almost over the 0 line, and they're rising, right? And I know as long as we don't have a bear bar, that 45 degree angle is going to continue, because that's just the way Renko works. So if I can either trap a seller down here or get a pattern, I'm good. So ring, triangle up. I did do this one, and it goes. Now, did I do the pullback, or did it pull back? Big move, right? Big move. So these are, yeah. So now each one of these, if I didn't do that, I don't remember if I did this or not. I don't think I did. Each one of these you could treat the same way. You could still find where's all the volume on the way up, and have we defended it with a star. So like here, if I ask like where, I don't remember. Tell me if I've already done this, but if I come up here and I see where all the volume is, you can sort of see there's a high volume edge right here before the VPOC. And then if I look to the right, there's probably a star there, and that's the entry. I don't know how, it's literally, that's how it usually works. Now, is that going to be a scalp or a swing? This is the scalp, right? Because look, what's to our left? We've got buyers potentially trapped. This one actually isn't that great because we don't have very much range. We really wanted this to be a bigger pullback. It's still valid, and it did exactly what I'd expect. It went to resistance, but resistance wasn't very far away. You still got your 10 points. It's still valid. It's fine. But we've moved a lot here. We pulled back to the edge. They put in a star, and you can take it for a scalp. But it's not always going to break this high, and when it doesn't, you need to watch the higher time frame. Right? This one does eventually break out. If you did keep a runner because you're trading with the trend, you just put your stop down here and you leave it there. and you get paid that way. Otherwise, it's a scalp and it's fine if you take it out early. So let me find another one. I want to find an obvious scalp where we've left buyers above us, but we have room to the resistance. So this, let's see if this one's set up, because I think this one might fail. Sometimes they do fail, but they usually work. So where is, let me erase all the volume profiles so I don't have too many to erase later. So we're asking about this move here. Where is all the volume going up, right? So this is the primary wave up. Most of the volume on the way up was right here, right? And then there's a low volume node here, or range. And there's an edge at the top and the bottom of that. So I would need to see a star show up here, or a dot. And it needs to defend that area to be able to get long. Now, if I drew it differently, I may have included this one. Oh, this star right here. Would I have taken this? This is on the way up. I'm probably not taking that. Personally, I don't have any range to resistance, right? I don't have any range. It's technically a star and it's technically pulling back into the area, but this is basically like right afterwards. So I have to think we're going a lot higher to take this. And I'm usually only taking a star like this if this is the low. But this is definitely not the low. So you can see on the bigger time frame, this is like after, we're above the channel, right? So I'm not expecting much of a move here. And I don't have any room to resistance, so I'm probably skipping that one. But if we push higher and then we pull back into that area and you get another star like defending this, you could take it. But now we've gotten underneath it, right? This star is not positioned appropriately, and not surprisingly, what does it do? It comes right back into the low volume area, the low volume node, and it rejects. It should make perfect sense, right? It got us back to where resistance was, and that old support that we expected to work didn't, so now it's resistance, right? That's just the way the market works. And then if it breaks over it, and it came back and it gave me a star, I'd long it. And this would have been a great place if it was a star. It might have been on this time frame. Nope. And this star just missed it. But remember, once you've gotten your entry, anything in that range is a buy. So you wouldn't even have to wait for the star if this was a star, but it's not, right? So if this was a star, you'd be buying, you could buy here, you could buy here, but it wasn't a star. So in this case, you don't know that this star existed until price is up here, and by then you've missed the opportunity to get a 10 or 15 point stop, because I don't think we ever came back there. Oh, right there. Again, that's your target, right? Do you have risk reward? Not off of your stop would have to go down here, right? That it could go as low as that. So like, I don't love it, because that's it's not 1-to-1, right? But let's see if we get a deeper. No, we need a star. Oh, that works. Again, I guess I can put my stop here now. That's not too bad, but my resistance is still very close. Trying to look for one that fails. There we go. Okay, so that one does fail. Now, did we have any reason not to take this? And I see one right away. Look what happened here. We have a lower high, but look at this. Higher highs, right? So that could potentially be a problem. We don't have any room on the indicator to get any higher. And like I said, if this is meant as a scalp, I really should only be targeting right here anyway. So coming off of this choppiness, like, it sometimes does work, but I want this drop to be big so that I can have a really nice retracement when it does work. Instead, it runs into something. Oh, the other thing you can do is you can actually measure where the volume was here, and I bet anything it was, oh, nope, it's okay. There must be some big, maybe I included too many. Whoops. There, you could, if you analyze this close enough, one of these volumes was way at the hot there. That was your problem. That had to be your target, but it didn't reach it. So there, that one's probably better. So see how, okay, I didn't realize that was kind of, this is a much better entry. Here's why. Okay, we said, I didn't realize you got another chance. This is a much better entry. So here's where all the buyers were, right? We had this buyer down at the bottom, right? We had this buyer up here, and then can I do, nope, all at the bottom, okay. Maybe I don't have a good reason then. Where is, yeah, I don't think I would be able to take this one unless there was a hidden high volume edge here. I guess I can look. But I don't, the only dot I see is this one, and it's kind of late. Oh wait, I didn't see this one. There's a dot right here. So there is a high volume edge around here, here, and here. Just, you'll have to trust me on this one. I can show it to you if you want, but I'll show it to you. You can do it manually. Well, if I can grab the damn thing, I can. I don't know. Can't seem to grab it. Trust me, it's there. So when we defend those, in this case, I would have to wait for the triangle because the dots. So do I have to wait for the triangle? So this star here, right, got trapped, right? Or what we call it got stuffed. Yeah. So I want to retake that point of control right here before I get long. This is kind of a nuance, but and that's why this one would have been okay had I had room to resistance, but I didn't, right? If this was where if this was the edge, this one's good, but unfortunately there's no risk reward, so I'd skip it, and here it fails. Well, now if this is still my target, if I can reclaim this with a star or a star triangle up, it's probably still okay. Because what we'll see is whether or not we have, so there's the star, there's the triangle up. So see how the triangle up reclaims this star? And now, do I have risk reward if I got in here at 31.50 and I put my stop at 18.50, right? So that's what, 24 points? Do I have risk reward? So 30, 50, I don't think I do. That's too bad. 18, yeah, that looks right though. Am I doing the math wrong? 20. Oh, it's not 24, it's 14. So I need 14 points of reward. So 40 5. Yeah. It's 1-to-1. I'd be looking for this where that volume is. I want to get right there. That's my target. If I think I can get there, it's valid. And there you go. And you're out. Target hit. Right? And again, that target came from this aggressive trader. I'm just looking at where the VPOC is. That's my target. And I know to get it because I came back into a high volume edge. Oops. I defended it here. And then I got triangle up. So you can either do it with ring triangle up or star triangle up, but I want to reclaim this trapped star. That star, getting under this star can create problems if you don't reclaim this. So once you get under it, you have to reclaim it to get a squeeze. Now, this one is better. Believe it or not, that entry is better. It's still the same location, right? You're still working the same location, but look, higher high, or higher low, lower low. So divergence to the upside, you can see we pushed into the Bollinger Bands here, so we have a reason to think it might be trying to get bullish. If you look at the higher time frames, we're probably going to see a big bullish move, right, before that. And so, whoops, where was I? So by the time you get here, star and a blue dot is usually good anyway, but as long as it's a decent location and you've got divergence, it's usually a pretty good trade, right? So I actually took that trade. And then note, this is that same pullback move that I was talking about before. And I can pretty much guess where all the volume was on this lift, you probably can too. Oops, I'm on the wrong one. So it's getting a little bit tight on the higher time frame, right? We're getting kind of pretty far from the channel. But if I wanted to know where all this volume was up to there, you can see that the VPOC is here. We pulled back below it and we closed above it. Once I get the triangle above it with the yellow line above it, I'm taking that trade pretty much every time. And then you could just keep expanding this volume. All right, so now I still want it to come back into here, right there. Pink, pink, triangle up, you can take that. Now this one gets to resistance, so that needs to be your target. If that target's too close, then you gotta wait for the next one, right? Note once we've given this up, higher high, equal high, but higher high. I guess there's nothing really that obviously shows it off here, other than the fact that we got above the purple here. So this should get above the 0 line, and it rejects. And that above the purple, but below the 0 line, I've been seeing that work out as a short. I personally took this and gave it up right here, believe it or not. I had that short, and I ended up taking a small like L on it because I waited till the triangle printed, and I'm like, yeah, I'll take it. And then it came back on me, and rather than putting my stop where I was supposed to, I wasn't sure about it, and so I exited. And then it totally worked. So sometimes, oh wait, that wasn't today. Okay, never mind. It was just like that. Here, I'll show you. I was on the wrong day. I'll show you the one that looks very similar to that. And then I'll close it out. Let's see. It was afternoon. Is it this? Yeah. Pretty sure. Maybe it was later than that. Here it is. This is it. So what I saw is trending down, rejecting off of the moving average, right? Usually bearish. Rejecting off the purple, usually bearish. Touching the purple, the downside Bollinger Band while the Bollinger Band expands. All of that is bearish, right? That occurred here, right here, right? Higher time frame, however, says bullish, right? We did not have a star triangle down here, and we've already done the wick, and so we should kind of expect the higher time frame to be pushing on us, but the lower time frame says, oh, we might be doing a pull, we might be in the process of a pullback here, is what it says right here. So what do I want? I really want divergence at the highs, okay, is what I really want, but here I got it, right? Lower low, or lower high, higher high, right? And then below the 0 line, so all I need to do is get the yellow line below the purple and the white, right there, right here. That is the proper short, right there. See that? Below the purple, below the 0, dropping, white turning to brown, star, all that's good, right? And instead, I didn't take it there. I said I would take it, I decided I would take it on a pullback and actually shorted this, thinking it might be as close as I get. And I figured if I get a triangle up, it's a bull sign, so I should get out. So I actually got out right there, only to see it go without me, and then I quit for the day. Because it wasn't right. I should have, like I said, if I was going to do the pullback, the way to do it is to mark that area and short that, not stop out there. But I thought it was coming up here. I don't know. Or do what we were just doing this whole time, which is figure out where all the volume is on the move down. Can I do this one? Nope. And see if you can get a retrace into there. If you can't, you need to do it on the next one. Okay, there is where all the volume is, right? Wherever the edges are is where I want to be getting a signal. Did I get a star? No. Orange bar, still usually not good enough. Oh, and that's where we are right now. So I would now need I would have needed a star down there for that to work out, and it did not. And then if you look at the indicators, you got a lower low here, right? But it's making higher lows. So that's bullish. And you got over the purple, but we have not yet got over zero. So if anything, it's kind of choppy, right? But we should be thinking higher because we don't, on the higher time frame, we don't see anything bearish. On the higher time frame, we're above the zero line on the BZO. We're above the purple, right? Everything looks good for pullback, buying pullbacks. And again, if you want to do this trick, you could say, well, where are all the buyers? They're right here where we are now. So stars on this time frame, if you can get good risk reward, are probably good buys, not sells. I didn't take it personally, but that one technically works as long as you can put a stop below this low. You'd have to put a stop down here because it's on a higher time frame. But if you like buy calls there and put your stop down here or do micros, that's usually going to work. Okay, that's pretty much how it works, guys. I am done, and I will see you guys all next time. If you want to get a hold of me, this is where to do that. And yeah, thanks for watching.